Hello everyone, welcome back to my channel. This is Ashna and we know why we are here. So without wasting any more time, let's get back to where we left. So just imagine that you are trying to understand the mood of a huge crowd and you cannot talk to everyone. So what you do is you ask a representative group, right? Now, based upon that, you assess what would be the mood of the crowd, right? Now, a market index is just like that. It is a snapshot of the market's performance which represents the overall mood and the direction. Now in India, there are two main indices which are known as the Sensex and the Nifty 50. Now Sensex is basically the index which tracks the performance of the top 30 companies which are listed on the Bombay Stock Exchange, whereas the Nifty 50 tracks the performance of the top 50 companies listed on the National Stock Exchange. Now these indices are composite, meaning they are calculated using a weighted average. इसका मतलब ये है कि certain weights are given to each company and these weights are basically based upon the market capitalization. It is calculated as the market price of the share multiplied by the total number of shares issued. Now this method is a bit volatile because the share prices can change overnight, right? So a more stable method is used globally, which is free float market capitalization. So basically it considers the shares that are freely available for trading in the public. So ये उन शेयर्स को हटा देते हैं जो प्रमोटर्स या बड़े इन्वेस्टर्स के पास होते हैं एंड जो आमतौर पर ट्रेड नहीं होते. बट एक्चुअल में कितनी कंपनीज लिस्टेड हैं बोथ BSE एंड NSE पर, दैट यू हैव टू फाइंड इट आउट. दैट्स योर टास्क ऑफ द डे. ठीक है. सो सी, a sheer number of listed companies on an exchange is often seen as a sign of a developed and a healthy market. Why? Because it indicates a strong economy with so many opportunities for businesses to raise capital. However, a high number of listing isn't always good. मान लो अगर कोई कंपनी लिस्टेड तो है लेकिन उनके शेयर्स में कोई ट्रेडिंग ही नहीं हो रही तो उनका होना ना होना एक ही बराबर है. तो अ वाइब्रेंट मार्केट इज़ वन विद एक्टिव ट्रेडिंग एंड नॉट जस्ट अ लॉन्ग लिस्ट ऑफ डॉर्मेंट कंपनीज. समझे? तो अब देखो, जो फाइनेंशियल मार्केट्स हैं दे डोंट ऑपरेट इन अ वैक्यूम. दे आर हेविली इन्फ्लुएंस्ड बाय द गवर्नमेंट एक्शंस, स्पेसिफिकली थ्रू मॉनेटरी एंड फिजिकल पॉलिसीज़. ये दो तरीके की पॉलिसीज़ हैं जो हम 12th स्टैंडर्ड से पढ़ते आ रहे हैं. Your monetary policy is how a central bank like the RBI in India manages the supply of money and credit in the economy. तो RBI इन्फ्लेशन को कंट्रोल करने के लिए या ग्रोथ को बढ़ाने के लिए इंटरेस्ट रेट को या मनी सप्लाई को बढ़ा या घटा सकती है. And the fiscal policy is how the government manages its spending and taxation to influence the economy. The union budget, it is a perfect example of a fiscal policy exercise. When the government decides to spend certain amount on, or let's say more on infrastructure, it directly impacts certain sector and the financial market. Now these policies are crucial because they set the tone for the entire economy. एक मॉनेटरी पॉलिसी जो इंटरेस्ट रेट कम करती है तो वो कंपनीज के लिए लोन लेना आसान कर देगी जिससे उनकी ग्रोथ बढ़ेगी एंड इन टर्न हमारी इकोनॉमी भी ग्रो होगी. सो दिस actually has a positive impact on the stock market. चलो ये सब तो ठीक है, but a $1 million question, what are the core functions of a bank? See, banks are the most important type of depository institution. उनका primary job is to accept the deposits and give the loans. Now what's happening behind this simple action is a series of powerful transformation. For example, your asset liability. Now when you deposit money, it is your asset and the bank's liability. The bank owes you that money back. But when the bank lends that same money to someone else, that loan becomes the bank's asset and the borrower's liability. Now this process is the heart of banking, which is how the money is circulated. Now another one is a risk transformation. Your deposit is a low risk investment for you, but for the bank it takes on significant risk because it bundles your deposit with others and then it lets it out as a loan. So comparatively it has a higher risk of default. So the bank effectively absorbs and manages this risk for the depositors. We all are aware that the depositors deposit small amount of money with the bank, and the bank can even lend a huge amount of money to a single large business, right? So this is basically your size transformation, wherein the banks convert the small deposit into large loans. Then we also have a maturity transformation. Now, this is a key and risky function. Why? Because the banks often accept deposits for a shorter duration, like a year FD, and grant loans for much longer duration. For example, your education loan, your home loan for 5 years or so. So the bank operates on the assumption that the depositors will either roll over their deposits or that new deposits will be made to cover up the gap. So this leads to what is known as an asset liability mismatch, wherein the bank's assets have longer maturity than its liability. So with this we come to a very important topic, which is a credit creation and modern banking. So see, banks have a unique ability to create credit and contribute to the money supply into the economy. The lower the reserve requirements are, the more they can lend the loans and leading to a higher credit creation. However, there is a major trend which is following nowadays, which is the banks are getting fewer deposits. This is because earlier people used to have very limited options, like पैसा है तो उन्हें FD करानी है, RD करानी है या करंट अकाउंट में पैसे डिपॉजिट करने हैं. बट टुडे देर आर न्यूमरस इन्वेस्टमेंट ऑप्शंस अवेलेबल टू पीपल आउट देयर and they are actually becoming financial literate, and that's why we can say that this situation has led to a point wherein the growth of loans is outpacing the growth of deposit. This also brings us to the crucial concept of economies of scale and economies of scope. So economies of scale yani the bank's size increases whereas the cost per unit decreases, and economies of scope yani the efficiency which is gained when an organization diversifies its services. For example, a bank that offers loans, insurance, wealth management can do more efficiently than the separate companies could do. This large scale operation helps reduce the surge costs, जैसे the cost of finding a borrower, finding a depositor, and the monitoring costs like the cost of tracking the loan, etc. for the entire system. Do you remember about the trend that we discussed a little earlier regarding banks getting less deposits with them? That brings us to the crucial concept of bank-led versus market-led economy. See, traditionally many economies, including India's, were bank-led. Banks were the primary source of funds for businesses and individuals. But now, a major shift is happening towards market-led economy. The growth of financial markets where companies can raise money directly from the public through stocks and bonds is now outpacing the growth of banks. This means that the stock market and the other financial markets are becoming a more significant source of capital. In contrast to traditional banks, cooperative institutions are a different type of depository institutions. So their core principle is one member, one vote, regardless of how much money a member has contributed. Their primary objective is to benefit their members and not to maximize profit. A great example of this is Amul. I would really appreciate if one of you could write the full form of Amul in the comment section below. So Amul is a cooperative that transformed the dairy industry, or we can say the credit cooperatives. So they often act as intermediaries between the banks and the grassroots organization like your self-help group. So we have talked about the different markets and the institutions. Now we look at the powerful tools that shape them and some modern trends as well. Remember about the monetary policy that I discussed earlier in this video? So monetary policy is a set of tools that a nation's central bank, in India's case it's the RBI, so uses to control the money supply and to influence the economy. The goal is to ensure stable prices and sustainable economic growth. So it's like the country's economic thermostat. The RBI uses various instruments to execute this policy. For example, your bank rate, which is the rate at which the RBI lends the money to the commercial banks for a long term without any collateral. Then comes your repo rate, which is the rate at which the banks borrow money from RBI for a shorter term. Like this, there are several other tools like your reverse repo rate, your CRR, SLR, open market operation, all that we have studied since our 12th standard. So I would not dig deep into this. So these policies, along with the government's fiscal policy, are crucial because they directly affect the financial markets. For instance, a low repo rate makes loan cheaper for the banks, which encourages them to lend more and thereby stimulating the economic activity. So now we move on to the next topic, which is your financial disintermediation. So it is basically the process of bypassing the traditional financial institutions like your banks and brokers to conduct transactions or investments directly. It's like cutting out the middleman. जैसे आप कोई चीज़ अमेज़ोन से ख़रीदते हो तो आप सीधे कंपनी से नहीं अमेज़ोन के थ्रू खरीदते हो, राइट. डिसइंटरमीडिएशन में आप सीधे कंपनी से डील करते हो. अ ग्रेट एग्जांपल इज क्राउड फंडिंग. So, a company directly raises money from a large number of people online without involving a bank. Another example of this could be your direct stock purchases plan, which is also known as DSPP, wherein the investor can buy a company's stock directly from the company itself, bypassing the brokers and their transaction costs. Now, let's go on understanding the mutual funds. So, a mutual fund is a financial intermediary and it's an investment vehicle that pools money from many investors and invests in a diversified portfolio of stocks, bonds, or other assets. So, it's an excellent way for small investors to get exposure to the stock market without having to research the individual stocks. The value of a mutual fund is measured by its net asset value, which is basically fund assets minus fund liabilities divided by the number of units outstanding. Another crucial concept under mutual funds is the expense ratio, which is a measure of the annual fees and operating expenses of a mutual fund. A higher expense ratio means the fund is more expensive to operate, which can eat into your returns. And this is why a fund with a higher expense ratio needs to generate a higher gross return to match the net return of a fund with a lower expense ratio. When you invest in a mutual fund, there are two primary charges that can affect your returns, often called as the loads. So they are typically your entry load and your exit load. So entry load is when this is the charge when taken from your investment amount when you first enter into a scheme. अगर आप 100 रुपीज़ इन्वेस्ट करते हो और एंट्री लोड अगर 3% है तो आपके इन्वेस्टमेंट अकाउंट में सिर्फ 97 जाएंगे. दिस वॉज द फी टू कवर द डिस्ट्रीब्यूटर कमीशंस एंड अदर इनिशियल एक्सपेंसेस. However, entry loads were prohibited in India by SEBI in 2009. So this was a landmark move to make mutual fund investing more transparent and cheaper for the investor. Then comes your exit load, which is the charge levied on your returns when you exit or redeem your investment. फॉर एग्जाम्पल अगर आपका इन्वेस्टमेंट 100 से 120 हो जाता है एंड अगर एग्जिट लोड 2% है तो आपको 120 का 2% चार्ज देना होगा. द पर्पस ऑफ एग्जिट लोड इज टू डिस्करेज द इन्वेस्टर्स फ्रॉम रिडीमिंग देयर यूनिट्स प्री मैच्योरली, which helps the fund manager maintain a stable corpus, and this is why the charge typically decreases as your holding period increases. So mutual funds are also divided into two categories, which are your open-ended and close-ended. जो open-ended mutual funds है, they are highly liquid. मतलब you can buy and sell the units directly from the mutual fund company at any time and at the current net asset value. This means that the total investment with the fund is always variable. It is changing as and when people enter and exit. So they are a good option if you need easy access to your money. Whereas the closed-ended mutual funds are much more illiquid because they have a fixed investment period. You can buy the units only during the initial offer period and can sell them only at the end of the scheme's tenure. अब बात कर लेते हैं इंश्योरेंस कंपनीज़ की. तो देखो, इंश्योरेंस कंपनीज़ आर ह्यूज फाइनेंशियल इंटरमीडियरीज. They collect a large sum of money from people in the form of premiums and then invest this money. So their main obligation is to pay out the claims only when a specific event like an accident or a death occurs. So which for many people never happens, right? So this allows them to collect money in the short term and invest it for the long term. So a crucial decision for any insurance company is premium pricing. If the premium is too low, the company won't be able to recover its cost or pay the claims. But if it is too high, then no one will buy the policy, right? So this is a complex balancing act which is handled by the highly specialized professionals, which are known as the actuaries. Usually the insurance companies, I must say good insurance companies, will have a diversified investment portfolio because they are spreading its money across various asset of classes to manage the risk effectively. Also, remember that the insurance and investment should not be mixed. The primary purpose of insurance is risk protection and not wealth creation. Long story short, let's move to non-performing assets. See, non-performing assets are classified into various categories. The first one is your substandard assets. Now, these are the loans that have been classified as an NPA for a period up to 12 months. Although the risk is high, there is still some chance of recovery. Another category is your doubtful assets. Now, a loan becomes a doubtful asset if it remains a non performing asset for more than 12 months. The chances of recovery are now very slim and the credit risk is significantly higher. The third category is your loss assets. Now, this is the final stage, and these are the loans with very little or no recovery value. So, the bank must actually write off the entire value of these assets from its balance sheet or sell them to asset reconstruction company to clean up its books. Now, let's discuss the last topic, which is your global financial crisis. The global financial crisis began with what are known as subprime loans. These loans were given to the people with a high risk of not being able to repay them. To manage this risk, the banks categorize these loans into low, medium, and high risk tranches. They then ask the credit rating agencies to rate these packages of loans. However, the rating agencies made a critical mistake. They rated the bank instead of the underlying loans themselves. So, as a result, the ratings were deceptively good. At the same time, a housing bubble was inflating. Property prices were rising rapidly, which encouraged more people to borrow money to buy properties. As they believed that prices would keep increasing, जैसे एक प्रॉपर्टी 25 लाख की थी तो उसके लिए 24 लाख का लोन मिल गया. So the bank was happy and the borrower felt rich. But when the bubble burst, the property's value plummeted to say like rupees 10 lakhs, leaving a huge mismatch. So a 24 lakh loan against a property worth only rupees 10 lakhs. Can you imagine? The crisis became global not because the initial value of subprime loans was massive, but because the same toxic loans were repackaged and sold multiple times as different financial products to investors all over the world. So this multiplied the quantum of the risk exponentially. From the bank's perspective, its balance sheet is a mix of assets and liabilities. While the loans are secured with the collateral, a bank's investments are not. A bank can get into serious trouble if its investments perform poorly. So this could lead to a situation where the value of its assets fall below its liabilities, causing the bank to go bankrupt. A major vulnerability exposed during the crisis was the short-term borrowing market, where the banks lent to each other. During the crisis, trust evaporated. No bank was willing to lend to another for the fear of default. And this short-term market was the first to dry up, which is often referred to as the silent run on a bank, a more subtle signal of distress than a full-blown bank run. Now, what is a bank run? See, bank run happens when all the depositors try to withdraw their money at once. Since banks don't keep all deposits in cash, this can lead to a collapse. A silent run comes first, followed by a visible bank run. To prevent this, most countries have deposit insurance schemes, which guarantee depositors money up to a certain limit if a bank fails. Now let's also talk about the regulator's perspective. See, during a crisis, the government and the central bank step in. They are there to protect the depositors. So they may increase the deposit insurance limit to assure people that their money is safe, thereby stopping a bank run. Another thing that they do is stopping the fire sales. So a fire sale is when an institution, desperate for cash, sells its asset at a very low price. So this can destabilize the entire market, and to prevent this, the regulator may inject money into the banks to help them hold on to their toxic securities instead of being forced into a fire sale. Another thing that they do is the bailouts. Now the government and the central bank ultimately use the taxpayer money to pump funds into struggling banks. Now this action is often summarized as the privatization of profit and socialization of losses. Now individual investors or institutions that benefited from the bubble get to keep their profits, but the losses are borne by the general public through taxes. So with this, we have covered the entire syllabus for Unit 1, and I would say that the more you connect the concepts to the world around you, the easier they will become to master. So I hope it was effective and a contribution made. I know that your exams would be near, that's why you are here. So, with this, I log off and all the very best for your exams.